President Trump's Department of War has bought a near $18 million stake in South 32's Alaskan joint venture partner, Trilogy Metals. The deal is aimed at advancing access to critical minerals in that region, highlighting the statesman's efforts to secure the country's domestic production of these minerals. South 32 says that the sum of the sale proceeds will be reinvested into Ambler Metals, an early-stage exploration project with known copper, zinc and silver deposits to support exploration and development moving forward. The competition watchdog has given Glencore and Sibanye Stillwater the green light to merge several of their chrome recovery operations. This will boost the miners' chrome production and help optimize value from future output of the ore. The decision comes at a time when the commodity is taking center stage in the country's critical mineral debate. South Africa holds 70 to 80% of the world's chrome deposits. Looking ahead, government is mulling a 25% tax on exports of raw chrome to protect the local ferrochrome industry. SA Corporate Real Estate is offloading its Bluff Towers Shopping Centre in Durban. The REIT is selling the mall to Tino's Consulting and Advisory for a price tag of 545 million rand. The move is in line with the group's plans to minimize its retail exposure in KZN. Proceeds of the sale will be ploughed into assets with higher growth potential. The disposal is expected to take effect on the 20th of December and remains subject to the fulfillment or waiver of the set conditions for the deal. Growthpoint is betting on the senior living sector. This via Growthpoint Healthcare Property Holdings. The healthcare-focused real estate investment platform has agreed to acquire Aurea Senior Living, a leading operator and developer of senior living communities in South Africa. The deal is valued at roughly 2.4 billion rand, including minority interests. It will add to 4 existing senior living communities in the portfolio, namely San Sereno in Bryanston, Melrose Manor in Melrose, Royal View in Sandringham, and Woodside Village in Rondebosch, Cape Town. Afrimat expects a bumper first half. The Mining and Materials Group projects that its interim earnings will nearly double. Headline earnings per share could be up 95% higher. This thanks to an improvement in sales volumes, particularly in local iron ore. Iron ore sales volumes more than doubled during the period, while total international iron ore export volumes grew by 13.5%. In the meantime, Afrimat's acquisition of Lafarge's local quarry operations is also starting to bear fruit. More detail will be provided when the company opens its books on the 23rd of October. Sticking with the doubling narrative, Data Tech eyes a more than doubling in interim headline earnings per share. The international ICT company says that this is due to all its divisions having delivered very strong financial performances during the period. Westcon maintained its expanding margin while its Logicalis businesses boast improved operational leverage, driving profitability much higher. As a result, headline earnings per share are seen coming in at between 21 and 23 US cents. Data Tech will post its results on or about the 30th of October. Finbond eyes a swing to profitability. The small cap financial services company expects to bounce back from a loss of 2 cents per share to headline earnings per share of between 0.88 cents per share and 1.28 cents per share. That's more than a doubling. The company primarily serves lower income and underbanked consumers who require small, short-term loans and will open its books before the end of this month. Government wants to accelerate transformation. The state seeks support from Afrixim Bank's Transformation Fund. In order to do so, government is looking for up to 51 billion rand in support from the fund to help black-owned enterprises. The country is escalating its membership of the bank in the absence of foreign sovereign membership. has restricted the lender's ability to extend support to local projects previously. Further afield, Novo Nordisk, the pharmaceutical company behind Wegovy, is undergoing significant restructuring efforts under the leadership of CEO Mike Doutster. As part of this major overhaul, the company has laid off dozens of employees at its largest U.S. manufacturing site for obesity and diabetes drugs. Here's more detail in this package report.
Novo Nordisk has laid off dozens of employees in the US. That's what Reuters has seen in a review of LinkedIn posts. The Wegovy maker made the cuts at the largest US manufacturing site for its popular obesity and diabetes drugs. It's a signal of where the firm is making cuts in a major restructuring under new CEO Mike Doutster. The layoffs are a small part of a planned 9,000 job removals globally. The Danish giant wants to sharpen its focus, trim costs and regain lost ground in competition with US rival Eli Lilly. The cuts also come as President Trump's administration pressures pharmaceutical companies to expand US drug production and create more domestic jobs. Novo last year became Europe's most valuable listed company on demand for weight loss drugs, but it's since had a sharp share price slide as sales growth slowed. It's now trying to reduce costs and staff that grew as it rode the Wegovy boom. A Novo spokesperson declined a Reuters request for further details beyond last month's global layoffs announcement.